So, Chawn, moving on. We rolling this thing. We
Okay.
on number 3.
Okay.
We on capital gains.
Capital gains. So, when you invest, this is probably the most common type of returns, if you will. So essentially, using that Apple example, you buy, 10 shares of Apple, and the value of the company, let's just say you buy 10 shares at $100 each. Okay. And it's 2021. But over time, Apple is going to put out new products. Apple is going to, have new services they provide, and the value of the company is continually to grow, right? So it may be a $1 billion company today, it may be a $10 billion company tomorrow. And when it gets to that point, the value of your shares increases as the company grows as well, right? So that those 10 shares at $100 each may now be worth $200 each, okay? And that difference, right, from the amount of money you put in and the difference from where it's now worth is what we call the capital gains, right? So the difference between what it's worth and what you put in. Now, in those capital gains, you have to be careful because, there's, not to get into much strategy, but whenever you pull those capital gains out, you have to pay taxes on it, which is not the end of the world, right? There's some metrics and ways to control that. But when you're thinking about the power of compounding over time, it's very powerful. And what I mean by that is there's this rule called the rule of 72. That says, you heard of it?
Nah, I'm about to though.
Okay, the rule of 72 says your money doubles every 10 years or so, assuming about a 7% interest, right? Rate of return, rather. So let's just say someone's 20 years old, they got 10,000. So 20 years old to 30 year old, that 10 turns to 20. And then 30 to 40 year old, that 20 becomes 40. The 40 to 50 year olds, the 40 becomes 80, 60. No. At 60 years old, you have $160,000, right? And that's just the compounding effect of having your money invested for a long amount of time with those capital gains, right? And that's assuming that you don't put anything else in it, right? That's just that same 10 grows to 160 in the span of 40 years. So imagine if you continue to contribute to that account, okay? And again, that's just a generalization, right? It's not guaranteeing that, but that's over time, that seems to be the trend since the stock market was created. So.
Come on, rule of 72. I ain't never heard of that. That's crazy. That's good to know though. So that's capital gains. So just in conclusion, just kind of rounding that up for you guys, it's the difference between your original investment and the kind of the growth of the stock when they make money. And he talked a little bit more about the rule of 72, basically saying that if you continually invest your money normally doubles every 10 years with a 7% rate of return. So if you haven't heard of it, definitely look it up, get more information. I want to get this money because I like when anything, if it double, I'm here for it. I'm here for it.